Morning, but yeah, we'll get going. So yeah, good afternoon, everybody. So this is the last of our 2024 Power Market Update series, where James is going to help us navigate what's currently happening in the power market and what's driving prices. So yeah, we are recording today's webinar so we can share with you after if you're here live or if you're watching back on demand. As usual, if you have any questions, just pop them in the Q&A and there'll be time at the end where James will run through as many of those as he can. I'll also drop a feedback link in at the end, and it'd be great if you could just take a moment to share your thoughts of us, just to help us shape our 2025 programme so we can carry on delivering the best content for you. So I think I'll hand over to James. Thanks, James.
Cheers, Penny, and good afternoon, everyone. Thank you for joining today. As Penny says, this is our fourth and final power market update of the year. I'm probably underselling it here. It has been quite an active and busy market. Lots of kind of driving factors we've seen over the last few months. And for those who are kind of new to these, kind of the setup is I'll kind of touch on and kind of go through the key drivers over the past 3 months. So kind of covering between the two webinars. I'll touch on some of the fundamentals, we'll have a look at gas storage levels, some geopolitics, wrap up with a bit of a summary, and then open up for questions. So if you do have any questions throughout, please put into the Q&A, and we're trying to get through as many of them as possible at the end. Right, so if we just start, I won't spend too long on this slide, but just start by looking at some of the key UK forward price contracts. So looking at December front month, Q1, summer 25 and winter 25. And I suppose just a caveat, this is from a couple of days ago, and it has been quite an active last couple of days with market prices rallying quite a lot. And again, obviously up another 4 or 5% intraday today. Obviously, it's been a very volatile year, which you kind of see on this chart, and kind of the scale of how low prices got in the early year, kind of mid-February, but we're still below levels seen from a year ago, but record highs so far this year for some key gas contracts. Probably a bit more useful if we look at a chart with a bit more data on it. So this is looking at the Q1 25 MBP chart, and this just kind of gives you a flavour of kind of price direction we've seen, and this is a snap from the 1st of June, so covering roughly the last 6 months or so. Now, if we kind of step through some key points, and this is by no means covering everything that's happened in the market over this time, but just some kind of key things which I thought were good to know of big drivers in the market. And I suppose just before starting, we just recognise the scale on this chart, obviously reaching a low down to almost 90p in September, and a high of around 120p. Actually, if updated this chart to today, it wouldn't be 115.9, which is stating here. We're up when I left the desk around 120 to 123 pence per therm. So if we cast our minds back to late July, early August, we had lingering geopolitics escalation as well. So we had escalation in the Middle East tensions, and we had again hedge funds adding to their very large long position. So a bit of bullishness there on kind of geopolitics and kind of fears of kind of what's going to happen this winter, which we're in now. And then a bit more kind of geopolitics as we go a bit further into August, this time kind of more Russia-Ukraine. And I suppose this story kind of blindsided the market a bit. It was when Ukraine actually started their incursion into Russia, into the Kursk region. Now, what was important around that, that's where the Sudza metering point sits. Now, the Sudza metering point is the last metering point that actually ships gas from Russia through Ukraine and onto Europe. The spike we see on that particular day was when we actually had a satellite image put out in the media, which showed significant damage to parts of that site. So everyone thought that gas supplies from Sudza were going to halt to zero essentially right away, and obviously adding a lot of premium to the market. That was proven to be incorrect. We've actually had stable supplies through Sudza and Velke since this date. We still have some uncertainties of what's going to happen in the future with these flows, but up until now, they've been very stable. If we go through kind of the back end of August and into early September, really kind of no news is good news here. So on the geopolitical front, nothing really coming out of Russia, Ukraine. Obviously, Sudso kept on flowing through that time. No further escalation in the Middle East. We had a load of Norwegian outages, planned Norwegian outages in September. They essentially returned pretty much when they said they were going to, so minimal delays there. And long-term weather forecasts were saying that we were going to actually get a very, very mild October to start winter. So that kind of alleviated some of that concern of what if we get a cold start to winter and we can't keep on injecting through October and turn to withdrawals quite early. On top of all that, at the time, we'd already hit over 90% full in gas storage, so already beating the European Commission target quite a bit earlier than needed, and therefore the market kind of just sold off on kind of that no news is good news aspect. We then get to the 19th of September, and you can see big volatility, big sell-off in the kind of afternoon that day, all kind of feeding from a false news story about an agreement to flow Azeri gas to Europe via either other routes, via Turkey, or via a swap deal with Russia. I suppose just to kind of step back and give a bit more context to this, that the flows that are coming through that Sudza metering point at the moment through Ukraine, that transit deal is due to end at the end of this year, and there's been concerns pretty much all through the year what's going to happen on January 1st, 2025. The market base case view at the moment seems to be pricing it all out. So we're not going to continue getting Russian gas flows through that time. Ukraine has made that point very clear. They are not going to continue dealing with Russia and giving Russia money to fund the war. However, there was news around this time, or kind of all through the year, that a deal with Azerbaijan could be done, and that was either flowing through Turkey and up to Ukraine, or via kind of a swap route. Now, it seemed quite unlikely at the time, just because Azerbaijan doesn't have the capacity to increase production itself, and really there was no capacity on pipelines going through Turkey either. So that didn't really seem viable. A potential swap deal did, where essentially Russia would supply Azerbaijan would reciprocate, but essentially it would be Russian gas still coming through Ukraine, just labeled as Azeri gas. Anyway, this was a fake news story, and subsequently, obviously, prices ticked up for the few weeks after that. At the same time, kind of early October, we did have further escalation in Israel-Iran, and there was, threats to nuclear facilities and oil facilities in Iran, and also fears that if Iran struck back, they could be targeting Israeli gas production as well. So fears that supply around the globe could be impacted by escalation in the region. So obviously that caused a bit of volatility at that time. You kind of get into mid-October, some milder forecasts coming through for the back of the month, kind of ease prices a little bit, and then up we go again, a lot more volatility. Winter risk really starts to kind of kick in, adding a lot of premium to the price. And this was a kind of early forecast of a very cold, low wind start of November. Therefore, we'd have to rely much heavier on gas storage stocks than expected. Again, back all the way down again, temperatures coming in a little bit milder, so kind of revising some of those storage forecasts we were concerned around. But also we had a second fake news story regarding the continuation of the Ukraine gas transit and a deal being done with Azerbaijan. Again, that proved to be incorrect the day after. More recently, though, and I suppose, as I said at the start, if we kind of rolled on this chart a bit more, today we've traded up to around 123 pence per therm, so another significant jump from what's shown here. It's really kind of fundamentals tightening quite significantly now. So we knew we were in a rather sensitive market, and if we were to get cold and high storage withdrawals, it would really kind of tighten the balances for next year. And that's exactly what we've seen. We've had quite a bit of cold weather through November, and the first week when we actually got mild weather was very, very low wind. So we've actually relied on gas storage much heavier than we expected. And although we're unless anything unforeseen happens, we are in a good place to obviously have enough gas to get us through this winter. The concerns are refilling next summer is going to be quite a task. We're going to really have to fight for that LNG to attract it to Europe over Asia. One other thing, I suppose, quite important, what's happened over the last week or so is OMV, so Austria's gas buyer. They won the arbitration victory over Russia's Gazprom, and therefore they came out, I think it was last Friday, saying they're going to stop payments as of the 20th of November to Gazprom. Gazprom responded saying they're going to cut flows as of last Saturday, which obviously spiked the market. Flows do continue, we think, are being traded just via the spot market, so not supplied through the long-term contract. But again, I suppose it's added concern that, or added confidence that, as of January 1st, are we just going to get a complete stop of Russian gas flows? If we go to this chart now, I thought this is quite interesting to show. So this is the TTF, so different kind of units. So this is euros per megawatt hour, the summer 25, winter 25 gas spread. Now, I suppose just to explain the chart, this kind of scale goes from negative, so negative 1.2 up to positive 4. Negative means that summer is a discount to winter. Positive means that summer is a premium to winter. Now, under normal market conditions, the summer will always be a discount to winter because you've got to incentivize storage to fill up in summer and withdraw in winter, and therefore you've got to have the money in it for them to do so. Now you can see it's been trading negative throughout kind of the horizon I've kind of chosen here. More recently, it's gone quite positive. And again, if I rolled that on to today instead of 2 days ago, we're back up at over €4 per megawatt hour. Now, the reason here is with the outlook looking a bit tighter fundamentally, with some lingering geopolitics as well. The thought is, we're still going to have enough gas for this winter. Filling up next summer is going to be hard. However, Europe has a mandate to get to 90% full by November 1st, with some other targets a bit earlier as well. At the current state, with current balance forecast, we're not going to get there. And therefore, the summer price relative to winter has shot up in order to kind of price in that tightness and obviously try to attract more supply through that time. So if we start looking at first few fundamental charts, now this is kind of the standard one we look at, European gas storage. Again, this is just showing stock levels through the year in a kind of a range going back to 2018. If I actually focus on the blue line, so this is kind of what happened last year, so summer and winter 23. You can see we filled up to very good levels and stayed very full up until kind of mid to late November. We had very, very mild weather through October and through much of November. We didn't actually really start seeing heavy withdrawals until the back end of the month. So we had a bit of a cold snap last year in kind of back November, early December, very mild through Christmas, bit of a cold in January, and then again very mild for the rest of winter. So then we ended the season at record stock levels. Obviously that took a lot of pressure off refilling in summer, and that's kind of one of the reasons, or the main reason, why we saw quite low prices earlier this year. Now, the red line is what's happened since the beginning of this summer. You can see filling up was a fairly easy task. We got to over 95% full. However, as we said, with kind of colder weather, low wind, low LNG imports into Europe over the last few months, or last month or so, we have started to withdraw and rely much heavier on gas storage. And the delta to last year is growing to 91 terawatt-hours, and I think that's probably a little bit wider if we included the last day of data there. So obviously we're still very early in the season. What the market is getting concerned around is we've still got several more months of potential cold and potential high storage withdrawals. So we're not in a nearly as comfortable state as last year, and it's very much going to be dependent on what's the weather going to be over the next few months, not just in Europe, but also in Asia. Next on LNG, so obviously, as I said, LNG imports have been quite low as of late. So this is just looking at monthly LNG imports into Europe, kind of split by source of where they come from, going back to January 2022. If we focus a bit more on the right of the chart, you can see we've actually had very low LNG imports through summer. Now that was fine. We didn't need to incentivize much LNG to come in summer because we didn't have too much of a need to refill gas storage because we're already at good levels. However, what we do need to do as demand goes into winter is start to attract those LNG cargoes to come back to Europe over Asia to meet our demand, and therefore not rely too much on gas storage withdrawals. Now, we have seen that to some extent in October. You can see kind of the September to October bar has ticked up a little bit, not nearly as much as we need, and again ticked up a bit more in November to date. But again, we really need to kind of start attracting that LNG back, otherwise it's going to tighten balances even more for next year. Next on LNG pricing. So I think it's been a little while since I've shown this chart in these kind of forums. What we're seeing here is the blue line is the Northeast Asian spot price, so kind of a marker for Asian LNG pricing. The orange line is TTF, so marker for European LNG pricing. Now, what we can see is that blue line, Asian prices have been a premium pretty much all through this year. So they've been the premium market. LNG is more going to them. Now, I suppose the one caveat here is it costs more to send to Asia. So if you're including the actual delivery costs, you would have to kind of drag that blue line a little bit lower to compare fully to that orange line, as it just takes longer for US cargoes to deliver there rather than Europe. What's happened more recently, and I think this might have reversed back out over the last 2 days, is the TTF actually went premium to JKM for the first time. And what we heard is over the weekend and up until Tuesday, over 10 LNG cargoes actually diverted away from Asia and towards Europe. So this is the market balancing and working as it should, as we've seen in the past. Is Europe prices have gone up at a faster rate than Asian prices, and therefore LNG cargoes are now switching destination and coming to Europe. Now, that doesn't say our kind of supply cavalry is coming and prices are going to go down. Very much we need that to continue through the winter. Obviously, if Asian prices tick back up, it's going to be a bit of a battle of who needs that LNG a bit more. I go to the next slide. So Russian gas transit, as I've mentioned a couple of times already, the chart here is actually just showing Russian pipeline gas through their what was kind of the previous 3 main transit routes. As you can see, back in early January 21 was about 3.5 terahours per day. Apologies, I didn't put the units on here. But for the last couple of years, it's just been down at around 0.4 terahours per day, 400 gigawatt-hours per day. And the only pipeline left flowing is Velkey, which is through the Sudza metering point, which you can see kind of on the image there as well. So Sudza is still active, flowing gas through Ukraine, and the main off-takers are Slovakia, Hungary, and Austria. Austria takes off their gas actually through Slovakia. So this is kind of the pipeline, the flows that we have been concerned that was going to stop potentially much earlier this year when Ukraine went into Kursk, where the Sudza metering point is, and also when the gas transit agreement ends at the end of this year. So it might not seem as much supply, but obviously a stable pipeline supply over a whole year, that does impact balances quite significantly, especially in the market we're in now, which isn't massively oversupplied. It's very sensitive, and it's actually looking a little bit tight for next year. So losing that gas or regaining that gas can kind of flip balances a fair bit. Now, obviously, I'm sure everyone's heard we will have a new president in the US. I haven't put any commentary on this slide. I thought I'd just talk around some key points, but if there's anything specific, please obviously ask in the questions. Now, thinking around this of kind of what market impact could we see from Trump taking office, I've kind of split into kind of three main points. So first of all is LNG policy. Now, we know earlier this year, back in January, Biden actually paused approvals for new LNG export permits, and that was on kind of the basis of officials updating their economic and environmental studies before granting those. So what that meant is projects that potentially were due to come online at the back end of this decade. So we're not talking about market fundamentals over the next couple of years. We're talking about nearer to 2030. that potentially we weren't going to get as much LNG come to market as we thought. So it'd be a less loose market, if you want, at the back end of the decade. Trump potentially could come to office and scrap all of that and just be handing out permits to everyone involved. And I think he's kind of hinted at that in the past. Again, this potentially will impact the market, but not until quite a few years down the line, increasing the amount of LNG supplies on the market. We still have a question around the demand. Is Chinese, Asian demand is going to grow and outpace LNG supply growth, or is this extra LNG supply that's going to come on cause another glut in the market? But again, this is for quite a few years' time. Second is tariffs. Now, we know the last time he was in office, he imposed very strict tariffs on China and actually stopped trade or made trade very expensive for both parties. This could also hinder Chinese growth and hinder Chinese demand, which would be potentially bearish for prices, or it could incentivize US LNG to come to Europe more than China as well. So again, probably very uncertain, but again, one of the risks of having Trump in office and kind of the unpredictability he could bring. Lastly is geopolitics, and I suppose, and this one is a big question mark. What's he going to do around the Middle East? What's he going to do with Russia, Ukraine? Middle East, we know he's a big supporter of Israel. Is he going to kind of back them more? Could we see further escalation there? Russia, Ukraine, he stated he could end that war in a day. If he does, is Russian gas going to come back to the market, or is going to be stricter on Russia as well? So I think on those ones, I don't really want to comment too much. I think it's too uncertain. We're going to have to just wait and see. I think he officially gets into office on January 20th. So a couple months to wait, but yeah, definitely potential volatility from Trump kind of taking office there, and some unpredictable things. Obviously, keep an eye on kind of what he's saying on kind of these policies going forward. And just to summarize some of the kind of key points I've split out here. So on the weather front, so far in November, we have had periods of cold. We had very low wind, particularly that first week in November across Europe. So both of these factors have increased demand above expectations, and combined with the low LNG, that has really tightened our balances for next year. And obviously that is reflected in the higher pricing, and obviously those storage stocks drawing down much heavier than expected. Now, going forward, obviously, weather's going to be a pivotal impact in driving price sentiment. If we do obviously get a very, even a seasonal normal cold winter, that's going to tighten markets quite a lot. If we go to winters such as the last couple of years, where we had very mild kind of Christmas weeks and Q1s, that could flip the market to long and obviously alleviate some of the concerns. But probably I'd say obviously weather's always important in winter. It's probably more important this year than ever. Geopolitical factors. So obviously there is threat to energy supply in the Middle East. That has calmed down, it seemed, over the last few weeks. Again, I think we just got to keep an eye on what's happening, what the involvements are in the region, and kind of see how that develops. I suppose it's been lingering on. We've had headlines all kind of through the year which have impacted the market. On the Russia-Ukraine side, obviously Russia recently, I think in the past weekend, escalated their attacks on energy infrastructure in Ukraine. And obviously with the use of US and now UK long-range missiles into Russia, there is a bit of fear in the market, particularly over the last day or two. What is Russia's response going to be? Are we going to see a further escalation in the region? Global supply storage, as I said near the beginning, all the Norwegian outages came back pretty much on time, so there wasn't anything drastic limiting supply there. US hurricane season was very active, but actually the impact on LNG sites was pretty limited. So storage, obviously, we reached over 95%, although with the higher demand, the low LNG we've had, we're going to rely on kind of storage withdrawals a lot more. So as we saw, stocks now already 91 terawatt-hours below last year. We've still got a bit of cold weather to come, and people will be keeping a close eye on those forecasts going forward. And I suppose lastly, if we do see any unplanned global outages to LNG trains in Australia or the US or Qatar, that will have, or potentially will have, a big impact to market prices. Global demand, I think this is probably the big question mark. Obviously, we're competing for LNG now. That is kind of our marginal gas supply, and we're competing with Asia. So we need to keep a close eye on weather forecast in the region and how kind of demand recovery is going there as well. We know China has done several packages to kind of boost the economy this year. And obviously, if that does boost demand growth over the next few months, that could have a bullish impact on prices. And that's all for me. Hopefully useful, hopefully covered most topics. But yeah, happy to go to questions.
Thank you, James. Right, we've got a few coming in the chat, so we'll jump straight in. First question up. So given the UK has been reliant on importing gas since 2006, why have our gas storage levels not been sustainably increased to give greater flexibility in terms of capitalizing when the market prices are bearish?
So if this is just touching on the UK, I suppose although the UK doesn't have big amounts of gas storage, I mean the gas storage we have left is more medium range storage, which can kind of flex week in, week out. Yes, it would help, but it's not the golden answer, right? As we've seen just in the market over the last few weeks, when you have a tight system, and you have the mandate on storage, the gas price explodes because they need to incentivize that LNG. So just building out extra gas storage facilities isn't going to bring down the price. You need to obviously diverse away from gas if you can, obviously building renewables, but also kind of build that more kind of stable supply in. So that's why obviously in the past we had that majority pipeline supply, which could only come to Europe. That was guaranteed, obviously kept prices low. When you're looking at LNG in a tight global market and you're competing with other countries, I think that is kind of where the main issue is. Obviously, bigger gas storage on a looser year, you could fill up even more. That'd be fantastic, but you still need that gas to actually be able to fill up the storage. And I suppose it's not just a question for the UK. We're interconnected to the continent. So whilst the UK doesn't have long-range storage sites, we're interconnected and kind of linked to the European market there.
Thanks, James. And another question, actually, obviously you touched on some of these crazy stories that are out there. Someone's just asked, do you have any idea where these fake news stories begin, where they come from?
I wish I did.
Yeah.
Yeah, it's obviously it will cause a headache for the whole market when these fake news stories get reported. We don't know where they've come from. I think it's probably a task for whoever reports them to kind of get their sources clear before they publish them, because you publish these news articles without any sources or with fake sources, it sends the market price crazy as we've seen, and will have an impact to lots of players on the market as well. So yeah, we're not too sure where they've come from, but I think that has been a risk and potentially will be a risk over the next month, right? We still have a bit of time for these stories to come out and manipulate the market.
That's frightening. Okay, great. So we've got another question. So was the storage withdrawal rate over October greater than you would have expected or higher than it has been historically?
So over October as a whole month, we actually injected into storage. I think we injected something around 10 terawatt hours over the whole month. Now, the actual injection rate was less than expected. So October, you kind of expect to flip to withdrawals probably at the back week or so of October. That's kind of when temperatures on a seasonal normal basis get cold enough. That obviously is going to incentivize heating, which is going to outstrip how much other supply you have. I think, as I said, 10 terawatt hours put in over the whole of October. We probably were expecting somewhere between 25 or maybe even up to 30 on a very mild scenario. So yeah, a little bit less full at the end of October, but pretty much there. We filled up to over 95%, which is obviously fantastic. Gives a lot of confidence to have that buffer going into winter. But with the tight market, the colder weather, lower wind we've had, combined with that, I suppose what the key thing is that low LNG. LNG just hasn't picked up when we've needed it, and we're going to have to be obviously competing with Asia to kind of attract that back to Europe.
Okay, thanks, James. So What else have we got? A few coming in. So should there be a complete stop of Russian gas flows on the 1st of January? How large an impact would this have on power prices, and would this impact be seen?
Yeah, so I suppose it's uncertain how much of it is already priced into market. I think the view is most of it is already priced in. I don't think many people, I think the consensus in the market is flows are going to stop. And if you're going by that and you're saying there's a 95% chance flows are going to stop, well, the market should be, when it's a rational market, pricing in 95% chance that they're not going to be there. So the price is already elevated because of that risk. Now, that's not to say if we get full confirmation of no gas supplies there, that there isn't more upside. But I think what would take the market by surprise more is if the flows continued. So the market is definitely pricing in a much greater chance of them stopping versus them continuing. But I think it's kind of, let's see the evolution over the next few months. As I said, we could see some more fake news stories trying to manipulate the market. I think we'll just have to see exactly what happens on the 1st of January. It doesn't seem that, well, I think it's pretty certain we're not going to have an agreement between Russia and Ukraine, obviously. What we could see is a European buyer step in and essentially buy the volume and take delivery of that at Sudza, so at kind of the kind of border through Ukraine, and then kind of manage it themselves. So essentially cutting out Ukraine there. I don't think the Azeri deal will go ahead, but again, never say never. I think we've just got to watch what happens over the next few months. It might be a case of let's see what they nominate on 31st of December and see what they flow on the 1st of Jan. If flows do continue, for I think the outside chance they do, you're still going to have rumblings of is it going to get cut off any day with the war going on, and particularly fighting in the Kursk region around that metering point. I suppose, yeah, just to summarize, I think it is the consensus in the market is flows will stop next year.
Okay, thanks, James. So a question around storage. So does the UK store gas in the Rough storage below sea?
Yeah, Rough is used to some capacity. I think their kind of longer term goals is kind of convert it to hydrogen, but it's not kind of used or can't be used to the same effects as it used to 5+ years. I can't remember when it actually decommissioned, but go about 7+ years or so. It just adds a small stable stream of supply through winter and kind of fills up a little bit through summer. But yeah, the reasons why it shut down several years ago was because it needed major investment, and I don't think obviously that's happened. I think the longer term plan is hydrogen. So adds a bit of buffer, but yeah, not much.
Okay, thank you. I think we've got time for maybe a couple more questions. So I'll grab, here's one on so are there any regulations or initiatives on the horizon to improve liquidity on seasonal contracts, FAR curve?
I don't think there's any regulations to improve liquidity on seasonal contracts. I think so you're probably relating to the old mechanism, the mandatory market making obligation, which is kind of forced liquidity, and it kind of went down to 2 market participants doing that, EDF being kind of one of them, and it was kind of fake liquidity on the market. Obviously, the big change we've had over recent years is the growth in CFD. In the CFD scheme. So a lot of the generation sites, so wind farms, solar farms, whoever gets the CFD, they essentially sell all their volume whilst under the contract via the day ahead auction. So they do not forward hedge their energy. So you don't have that selling interest further out as much. And I suppose on the buying side, what we've seen, because we've gone through the energy crisis and very, very high pricing, a lot of particularly resi customers, and most of them are on SVT, the price cap. So that is just done essentially mostly quarter ahead. Or business customers, instead of taking 2 or 3 year deals, I think the standard term now is 1 year. I think in 2022 it even went down to 6 month. So you've had kind of changes on both sides where there's these renewable projects in the market, they sell more shorter term, kind of more just day ahead, and you've also got a less buying requirement on the curve as well. Now, obviously, I think in time it will adjust itself. but liquidity is there. We're EDF, obviously we're still sellers of nuclear down the curve. We're still buyers for our kind of our business customers as well. So yeah, we're happy, we're fine with liquidity at the moment, but I suppose it's just changed quite a bit over the last few years.
Okay, thanks, James. And a last question, I think. So, in your view, have the markets priced in an end to the Ukraine transit deal in December, or is the expectation that an agreement will be reached?
Yeah, so like before, I think it's got to be mostly priced in now. It'll be impossible to say how much of it, but yeah, around the industry, I think the consensus is it stops. There will definitely be people out there who think the flow continues, but you'd probably have to be a brave man to position against it. And I suppose something I haven't mentioned in this session is investment funds. Obviously, investment funds are a lot more active in the gas market with the increased volatility. They are very, very long at the moment as well, 270 terawatt hours long, which is a significant amount of volume. So yeah, if people were going to position against that, it's obviously over the last few months that would have burnt them as well. So consensus is it doesn't flow. As I said before, let's see the developments over the next few months and then see the reality on January 1st. It definitely has beaten up the market this year, considering kind of all the news stories of going around of citizens being blown up. Oh no, there's been a deal, no deal. I'm sure it'll keep us on our toes for quite a few more weeks.
Brilliant. Okay, well, thanks, James. As always, it's been really insightful. And thank you, everybody, for joining us today. I've just popped in the chat a link just to request some feedback from yourself so we can continue the programme into next year. So do look out. We will be setting these back up. So come and join James and I next year for some more insight into the power market. In the meantime, this is just a reminder of how you can get in touch if we have missed any questions and or if there's anything we can help with there or give us a follow on our LinkedIn page as well. We've got one final webinar left to go of this year. So we've got Monitor, which is our non-energy cost update webinar happening on the 12th of December. And then we've got one in the new year if you want to come and have a look at a strategic look at energy policy from this year and into the year that's coming. So you can sign up for those on our Talk Power pages. But yeah, thanks, James, for all your updates across this year. They've been really helpful, and we look forward to continuing back into 2025.
Thanks, Penny.
Thanks, James. Thanks for joining.